Okay, we
We
are
are
live.
live. Good day, everyone. I was going to say good morning, but it's actually not the morning. It is dark outside, and it is the evening in New York. I believe it's the same for you, Daniel. Cold up there in Canada, and this is the 11th Stock Talk episode. Thank you, everyone, for coming back every week. We've been having a ton of fun doing these. It's something Daniel and I look forward to, and this one is at a special time. Daniel and I do have lives out of stock and lock sometimes, few and far between, and we're both busy tomorrow. So thank you for joining us. And if you're watching the recording, giving you a delayed wave because that means that we are not live anymore. But anyways, Daniel, how has your week been? It's been another fun week for the stocks, hasn't it?
Oh, it's been another good week. Honestly, like not too dramatic this week, I felt like in the markets. Kind of just, at least I didn't notice anything crazy really going on this week. So I don't know about you.
No, I didn't even buy any stocks this week. One thing that I did like was I did announce on the 10th stock talk, I did start a new position in Airbnb. I was also unhappy that the stock then ran up 10% since I wanted to continue dollar cost averaging in. That stock did start to come back down. So not that I ever hope that people lose money or things like that, but I am looking forward to seeing some cheaper stocks again, hopefully, because I feel that we're kind of dead cat bouncing through this recession, and I just can't believe anything nowadays. We'll be up 5% and like down 3%. It's just too much to watch.
It is really too much to watch. It is funny though, hey, how like you buy a stock and you're happy like you bought Airbnb, and then you kind of want to build your position over the next month or two. And really what would be the best is just dollar cost average every single month, right? Like buy some cheap shares every single month. But then the stock runs 10, 20, 30%. And then you're like, man, well, what? Well, okay, I got like 3 of the 30 shares I wanted, so that sucks. So, sometimes you kind of do want the stock to continue going down or at least like stay cheap for you. But yeah, right now it just seems like that's not happening. Everything's
Yeah.
everywhere.
Yeah. And speaking of stocks, today is a slightly special episode. Usually we come in, talk about a current event, but we're just here to talk stocks today. We see Purdy in the chat, Yen in the chat, Shane, Vijay, Dominique, Financial Josh. If you guys got stocks for us, throw them in the chat, and we're just going to jump straight into that stock talk. I'm overdue to look at some stocks. I want to look at that juicy financial data and analyze these stocks. Favorite part of the week.
Jake, is there any stock that like you're interested in that you want to take a look at just to get us started?
I have not taken a deep look at Baba's earnings yet. However, I'm not sure if those have hit stock unlock yet.
No, I don't think so.
So here's an interesting thing, Daniel. You like utility companies, right? Yes. I'm going to throw you a very weird point of view.
Okay.
I invest in stocks and plan to hold them for 5, 10, 15, 20 years, right? So I like to go into industries that I think will be around and continue to stay sustainable, all that. I know our styles are a little bit different here, so this is not meant to be a bash at all, but I do want to poke at you on the utility front. I'm going to say something kind of crazy here. I believe that in the next 10 years, calling the shot, that the entire energy sector is going to be flipped on its head. I think that houses will start to become their own individual energy sources. I'm not kidding. Whether that be a micronuclear reactor, having solar energy, which now works not when it's only sunny because they've made the chips so much better. We are heading towards a world where the cost of energy, I think, is slowly going to zero. And that is also compute power and things like that. So I know that's very broad. I also know that this doesn't blanket every utility, right? Like it's a very broad term. So that's what I want to bring to you today. Like I don't invest in utility stocks because I genuinely don't feel confident that the industry is going to be in the same place in 5 or 10 years. And that for me right there just has me looking at other things that I feel that I could understand better.
Yeah, I mean, fair enough. And by the way, I wasn't laughing at you for your opinion. I was laughing because I was making like stupid faces as you were explaining it being over dramatic. So sorry about that. No, I mean, that is something I've thought about, right? If I like my roof, for example, the roof on my house is perfect for solar panels, right? So theoretically, I could just line my roof with solar panels and maybe generate all the power I ever need. I just don't see that happening yet. It's on my radar, but I think that you'll see it in the fundamentals of these utility businesses. And right now, every utility stock I own is the fundamentals are growing super well. So as of right now, I think it's not something that I really got to worry about, but it is interesting. Also, I do think that up here in Canada, we are never really going to get off natural gas. I don't want to say never because that's really dramatic. We probably will someday, but I don't think it's going to be in like the next 50 years because my roof is perfect for solar panels, but we also get like 3 feet of snow. And then I'm not going to be up on my roof cleaning off my solar panels in the winter, man. So my house is heated with natural gas. And also, natural gas is so freaking reliable. It turns on every day. You know, I just set my little thermometer thing in my house and boom, I got heat. Like if my solar panels or the battery in my house were to stop in Canada when it's minus 40 degrees Celsius, that is a very, very bad thing. My pipes are going to burst. Everything in my house is going to be frozen. It's going to be a really bad situation. So personally, I don't think, even as a Canadian, I would be willing to even trust the renewable energy right now because it's not the most consistent thing. So yeah, we'll see. Who knows?
Yeah, it's going to be a fun one to watch play out. I'll end this with a funny joke as I do. So there's a startup company idea in that, Daniel. So I hear your problem, right? You can't buy solar panels because it snows a lot. So that's why the solar panel needs to then double as a snowler panel, and it will get energy from the snow. That's
You know
obviously a joke.
what we need is solar panels with like windshield wipers on them. You know, just like you just hit a button once a day. It's just like and there you go. That's
Anyways,
it.
we got some good stocks in the chat. Thank you all who heard our ask there. We are taking stock suggestions. We're going to get into stock talk. I see Honest, Crocs, ATZ. Of course, everyone's talking about TMS. I know that you mentioned that in our newsletter you sent out today. We have Stag. We got DQ, which I know I'm pretty sure that's the one with the very high insight score, correct?
Yeah,
So,
it's like one of the highest stocks right now.
Yeah, so I guess take your pick. As always, we're going to try to get through as many of these requests as we can. So keep them coming.
Okay. All right. Yeah, there's a lot here, dude. Wow. Okay.
Yeah,
I'm gonna start.
You guys are awesome,
I'm
guys
gonna
and
start.
girls.
I'm gonna start with VJ. Okay, I'm gonna share my screen, and I've learned a hack here. Okay, so we can share the screen, right? And then to avoid this, I can just put this over here, and now you guys are looking at my Photoshop. So that's that. We're going to open up Google Chrome. Yeah, don't you like my photo of Calgary? I took this, by the way.
Daniel, I'm going to pick on you a bit here because we've been friends for over a year now, and your computer skills have really improved, and I want to take some responsibility for that.
You can also tell I wasn't fully ready for this, but here we are. We're ready now. All right, we're taking a look at Rost. So right away, insight score 3.25. Okay. So this stock is up a lot since the year 2000, like a lot. Okay, compare this to the SPY.
It's a big company too. I see it's worth $34 billion. So I'm curious the cash flows this business is generating in their growth, and as well as what does this company do, Daniel?
I have not figured out yet. All I know is it's really smashing the SPY over the past 20 years. Over the past 10 years, looks like it also looks like it had a recent run up. Over the past 5 years, it's underperforming the SPY though, so that's interesting. All right, yeah, let's figure out what this company does. Ross. Oh, this is Ross, the company Ross.
I've never heard of Ross before.
Oh, okay. Well, they are an off-price retail apparel and home accessory store. The company is headquartered in California and currently employs 100,000 full-time employees. So yeah, they're like an apparel and fashion store, retail apparel across the United States. I can't believe I know that and I'm a Canadian and you don't. That's crazy.
Dude, I'm not a consumer.
I guess so. All right. So, well, first off, what I'm noticing here is like in the past month, I imagine that they reported earnings. And when they reported earnings, like this looks like an earnings jump to me because this stock jumped like freaking over 10% in like the past day. So yeah, I'm going to assume that was earnings. But let's take a look at what's going on with its financials.
I can't believe that they employ 100,000 people. I mean, that's like an Amazon-sized company right there.
Yeah, it's huge.
Wow.
Dude, look at this. Look at that revenue growth too. So basically, for like 20 years, this company's trailing 12 months revenue grew almost every single quarter until the pandemic happened, and then it saw a slump in revenue, and now it's kind of looks like it might be topping out. Like right here, kind of see some topping action.
Actually, I just got nicely reminded by my girlfriend who's behind the screen that this Amazon is actually around 10 times the size of this company. So I'll correct myself there. They have what I was just showing around 1.4 million employees, which is 14 times 100,000. So correcting myself in the live stream. Sorry about that, everyone. And thank you, Taylor.
Okay, so we can see right here that the net income tanked. Like absolutely tanked during the pandemic. Wow. Okay, and then it's like struggling to come back. It's actually still below 2019 highs, which would probably explain the stock not increasing. We can also see here the operating cash flow in the trailing 12 months is still below 2020 highs. It's actually quite low.
Yeah, that's a concern to me. One thing I'd be curious about this business, Daniel, because financials is one part of it. I know that it seems like they have a lot of physical retail stores. I'd be really curious to see what their online presence is and their ability to execute and grow there. I've seen consumer trends moving in the direction of shopping more and more online, obviously. So I do wonder what their plan is.
Yeah, I mean, it honestly looks like the stock reported earnings like either today or yesterday. So we don't have their most recent financials in stock on a log yet. So it's going to be hard to like really account for what's going on here. But basically, it looks like this company's revenue is still growing, but the cash flows for this business are not quite growing with the revenues, which would also mean their margins are not going up. Their margins are probably going down, which is exactly what we're seeing right here. Operating cash flow margin is 1.8%, and the trailing 12 months used to be about 13%. So basically, the profits are not growing with the revenue for this business, which we could also see in the freeform tool here.
Yeah, there's some insider selling happening. Nothing too crazy, though. We got one sell recorded from this year, and then there's some more selling in 2021. I'd say my whole thing with these businesses, Daniel, is thinking about a company holistically here. What edge does this company have, right? And like, I won't be able to answer that because I don't buy their products. But if anyone in our chat is thinking about investing in this business, what competitive edge do they have? Are they a competitor to Amazon? Like, what makes this business unique? And maybe they had a great retail store presence. Is that going to continue to thrive and do well as the new digital economy grows? And just really trying to understand like what the company's plan is. What we can't see here is their forward projections and comments from management saying what they plan to do to continue to grow that revenue. Because yes, it's been nice, but yeah, like you said, Daniel, seems like it's topped off. Cash flows are going down.
Yeah, like honestly, right now, just based on the financials, I'm not really seeing much to love. Like, I mean, before the pandemic happened, yeah, they were like this clearly growing company, but now it looks like kind of looks like the pandemic may have changed things. And like now their revenue is actually starting to come down in the trailing 12 months. Like, as you said, consumers are now more spending online. Like, are they adapting well to that? I don't know. But right now, with their cash flows going down, their margins declining, I don't love it, to be honest. And as I like to say, there's just so many good companies out there that, like, at least right now with Ross, when I would compare this to something like Google, with Google being, in my opinion, quite cheap right now, like, I just, I have a really hard time wanting to buy something like this over Google.
Yeah, and the person who asked this question was Vijay. We have two more comments from them. Online presence is really bad. So not a good sign. And also, it's just that they have more presence in West Coast compared to Burlington stores and TJX. Okay. So yeah, they got competitors. Yeah, I agree with you, Daniel. Nothing really made me excited to want to dive deeper on this company.
Yep, same here. All right, we got another couple people talking about Honest. Oh, this is I know the stock. Okay, this is another YouTuber stock. Let's just say that. So this stock was $23 a share last year. It's down 86% now. So I believe that what this company does is they sell diapers, baby wipes, and I think some beauty products. I'm not confident in the beauty products though, but immediately I'm seeing a low insight score right here of 2.31, which is bad. So let's take a look. Profitability 1.57. Their gross margin is average. It's okay at 30%. Operating margin, net margin, free cash flow margin, all negative though. unprofitable, free cash flow negative, and even operating cash flow negative. So they've lost about $54 million in the past year. This is a small cap stock with a $30 million, or sorry, $300 million market cap. So this is how I like to think about stocks, okay? Because we're buying real businesses, right? So let's think about this. So let's pull out our calculator. This is a $300 million company. In the past year, they've lost $53 million, I think that said. So 53 divided by 300 means that this company in the past year lost about 17.6% of its entire market cap in negative free cash flow. So instead of this company producing cash for you at its market cap today, it's losing you 17% a year.
I'm gonna add to this, Daniel. Sorry to cut you off, but it does get worse too, because it seems that this company just went public recently, and it seems like every single executive is selling a lot of their shares. So if you, that's it. It's a bad sign.
Also, we can see right here the revenue hasn't really grown since the first quarter of 2021. So it's been about 18 months, and the revenue has grown by 1% net in the past year and a half. That's not really good, especially when you're burning cash. Like, let's take a look. Negative operating cash flow, what? Every single quarter, negative operating cash flow in the trailing 12 months. Again, they lost that 53 million. So I'm just going to imagine, okay, if they became public last year, they probably saw a massive boost in their cash because they did an IPO, raised money. But now that they're unprofitable, they're probably going to be burning through that cash. This is what we see with Tattooed Chef, Beyond Meat, Oatly, Fubo, all these types of companies that are unprofitable. And we can see right here that, okay, at the end of 2021, they had $93 million in cash, and now every quarter it's going down. And now they're sitting at about 41 million. So if we actually head to our insights, this will mean that we have a cash runway insight right here, and they got about 9 months left of cash, so about 3 quarters. So if this company does not turn things around and become profitable within the next, 9 months, then they're going to be in a really tough place financially. And they're either going to have to take out a lot of debt, or they're going to have to dilute their shareholders. And if you dilute while your stock is down 85%, man, that is not a good thing. That is going to destroy shareholders. So I think this is a very risky stock. I would not own this. I think it's incredibly speculative, and I think it's very high risk personally.
I agree. Not financial advice, of course. And Daniel, I would bucket these. You said something on your last stream that made a lot of sense. A lot of companies went public and IPO'd in 2021 when we were in a stock market bubble, and generally the market, aka Wall Street, was rewarding revenue growth. It seems that this company came on, either had great revenue growth, which could have been a faux pas product market fit during COVID, as well as them likely projecting that they were going to make a lot more. They obviously are not. And here we see the stock price tanking. This is, like you said, same old song and dance for a lot, not all, but a lot of companies that went public in 2021. So not all these companies are going to survive too, just statistically. Like, people need to realize stocks can go to zero. Like Peter Lynch, right? People say, hey, how much money can I lose on this stock? Everything. Any stock can go to zero. Like, it's a simple point, but it's one that people overlook a lot. So be careful out there.
Yeah, I definitely agree with that. And I also agree with you. This is a little bit off topic, but I made a YouTube video today on my main channel talking about the stock I bought. And we talked about it here on the channel before too. It was Dental. And I mean, Dental is continuing to hit 52-week lows because it did an IPO last year. And I think that a lot of people are just selling off all the IPO and like SPAC stocks together. But as you said, there are some companies in that group that are good. So
Airbnb.
Yeah, exactly. Airbnb was one of them that IPO'd last year. So I think that there could be opportunity in those because, I don't like to bucket everything in one place. But we have another request for Spotify.
I'm excited for this one. I started getting jumpy when you put it up. I have been a Spotify customer for literally 4 or 5 years, paying their subscription fee every month. I love Spotify, but do we love the stock? To be determined.
Well, I can tell you your subscription fee has not helped this stock at all. So
should I throw them a tip? Like I'm going out for dinner? Wow. I was going to say, since we always look at these as companies, one pro for me is I do like to understand the business. And a lot of my friends are Spotify subscribers. A lot of my friends have it. So right off the bat, the thing I just like about this in general is you can understand what they do and they have a big consumer base. So I guess the questions we want to answer here, Daniel, and let me know if these sound right to you is, are they growing? Are they trading at a fair value? And do we see this company growing and returning more value to shareholders in the future, whether that be through financials growth and or like a dividend, things like that?
Yep, absolutely. And I also am a Spotify subscriber, and I have been for years. I actually love Spotify's product. It's like the only way I listen to music, actually, now that I think about it.
Yep.
So,
Podcasts too.
yeah, podcasts too. Exactly. Like they're actually a really great product. And it's sad to see that their stock is down, 45% now from their IPO in 2018. So it looks like the stock, it did well in 2020. It saw a massive run of like 184%. I'll zoom in here. So yeah, it saw this massive run, actually 200% run in a year. But now, since the top, it's down almost 80%. Wow. Okay.
I'm looking at their financials and it reminds me of what Uber was doing like 2 years ago, where like their top line is going up, but they're not making money off of it. They're like spending more and more of that. So it's a really interesting play, right? I think there's a real good argument to be made that when companies invest properly and build out these huge platforms, it's actually okay to lose money because at some point you like turn on the profitability dial in the business and get cash flows more by your choice rather than a company like Honest, which is struggling to get that at all.
Yep. Yeah, I actually have a company in my own portfolio where they're intentionally running the business at break even, like it's zero. They spend every dollar they make to continue fueling growth. I like that. So I see what you're saying there. The
Does
problem is,
management say that in their reports? Like, does management say we are very aware of this and we're doing it on purpose?
yeah, and historically they had a 45% operating cash flow margin. So like they had that before, and then they were like, okay, well, we want to grow now. Like it's time to grow.
That's
So
hot.
it's hot, dude. That's
Dude,
right.
hot stuff.
but that's what I mean though, is like the company has that proof, and I'm very confident that they can turn on the cash flow tab. But as you said, with a company like Honest, it looks like they're struggling to turn that on. And like it's getting to the point now where they're in trouble. They're going to be in more trouble soon. So yeah, we got to see if that's the case here for Spotify. For Spotify, you can see that revenue growth is just incredible, like very strong revenue growth.
And where their revenue comes from is, I'm taking a slight guess here, but it's recurring subscription revenue. And people like Warren Buffett, as well as us, and Stock and Lock actually works this way as well. It's a recurring subscription product. That means that the cash flows are pretty predictable. When you could look at the retention rates of those users, the likeliness for them to stay, and things like that. Companies like this, when they get their revenue through recurring subscriptions, investors love because it's pretty predictable what you're going to get. Not obviously promised, but way better than companies that do one-off sales, right? Because then you'll have kind of more spiky revenue sometimes, and you're able to make a ton more during Christmas time, but then fall off in the summer, which makes it a little bit harder to price the stock, in my opinion.
Yeah, no, you're absolutely right. So I just want to do something here because I love, just every time I can make this point, I love to do it. Revenue growth is not the holy grail of investing, okay? It is not everything. Take a look at this. If it was, then Spotify stock should be at an all-time high right now and following the revenue, but it does not follow the revenue, because what matters when you're investing is the amount of cash that business can make for its shareholders and return back to them. So let's go and take a look at that now. If we take a look at the cash from operating activities, I mean, it grew right here in 2019, but ever since 2019, their operating cash flow is just not really existent. So where is the company spending its money? Its cost of revenue is quite high, so its gross profit margin is not that amazing. Like,
Yeah. So I have looked at this business a bit, Daniel, because I do like to invest in things I know. And obviously, we both established we've been subscribers to Spotify for years. The thing that kept me away from this business is I don't understand the music industry and how those payments work. I know that there's been some beef with Spotify and Taylor Swift in the past in terms of what they pay artists, what they get paid. And artists are a very loose breed. Like artists could give a crap less about Spotify, in my opinion. What artists care about is distribution and rights to their music and them actually getting a fair share of those profits. And I just fear that, even though I can't theorize what it would be, just that there could, in theory, be a product that starts pulling these other artists away, where it's just like cheaper all around. And with a business as big as Spotify, I start to question how quickly they can churn out product and how nimble this organization still is to like respond if, you know, massive changes happened with how they got kickbacks from artists, or that, like, you know, a bunch of artists leaving the platform, like even Joe Rogan podcasts and things like that. It is similar to these streaming companies becoming kind of like a digital property play, right? Like people have Netflix, so they have certain movies and TV shows, but then you need to get Disney to get like their special movies. And like there is a moat around having like your own content and things like that. Spotify doesn't actually really own any of their content. Like it's other people's content that like Spotify hosts. And that to me made it really challenging to like predict how they're going to do in the future. I just honestly couldn't answer that question. So,
well, what I can tell you is they probably don't pay their artists very much because these margins say they can't. Like their operating cash flow margin is 3%. Their operating margin is negative. Their gross margin, like their operating margin is negative. And even for a software business that runs on a subscription, their gross margin, or sorry, gross margin, not gross profit. Gross margin is only 25%. So like for a software business, this is a very low margin. Like if you go and take a look at Adobe, for example, if you go take a look at Adobe, for example, which is, Photoshop, their operating margin is all the way up here at 88%, or sorry, their gross margin. Wow, I cannot talk today. I apologize, everyone. But their gross margin is 3 times as much. So for a software business, I think Spotify just doesn't generate that much revenue, or sorry, that much profits. I think their profit margins are thin. They don't really have a history of expanding them. So for me, as a cash flow investor, I just don't know how much money this company would actually be able to give back to me in the future, even if they continue growing their revenue. So that makes me a little bit uncertain. And because of that, I don't think I'd own it. It's also got a pretty low insight score here of 2.23. You can see the profitability score is 1.8. Yeah, operating margin negative, net margin negative, free cash flow is low, 1.7%. Financial health seems decent. Cash more than current liabilities, that's good. Revenue is growing. So yeah, you can see right here, growth is 2.0. And this is why I love our insights, man, is because we don't just score revenue. We score everything. Revenue is growing. That's good. But operating income's not growing. Net income's not growing. Operating cash flow is decreasing. Free cash flow is decreasing. So all these other metrics that investors care about are not growing with the revenue. And to me, I really don't like that. So for me, I think I'd pass on this one.
Yeah, I would consider a like very small spec position potentially. And to be clear, I don't own the stock and I have no plans to do that. I don't immediately write it off. But yeah, as you said, not super profitable. Also not going under. So like this doesn't look like an Honest or Beyond Meat where they have a ton of cash issues. Revenue's growing, which is nice. And a little bit of a right turn here, Daniel. Actually going to take a question from the chat quick. Maybe you can look for another stock to queue up.
Yep.
This is a question about Stock Unlock. So, of course, Daniel and I are 2 out of 3 co-founders of this business. You can go to stockunlock.com, check us out, learn a ton about investing. Where is the best place to look for analysts' estimates? The analyst estimates on your website is not the same as I see elsewhere. This is a great question because part of being an investor is going under the covers and really asking like, okay, sure, here's the data, but then also, what is this data? Where is it coming from? And not everyone asks that second question. So the reason why our analyst estimate numbers don't match other sites, and I would actually go a step farther and say, if you looked at an array of 10, 15, 20 sites, there's going to be very little overlap. So sure, it's fair to say we don't match other sites, but other sites don't match each other and vice versa. The reason why is the pool of analysts that data providers pick from are different. And there's tons of different firms that have analysts. There's no one that I know of that actually takes the entire pool of every analyst ever. So every data provider has their own relationships with different financial firms. Our data provider is FinHub. So the analysts that they source, as we're told, are from both buy-side, sell-side analysts to get the full picture. And they try to pick, a pretty diverse group as opposed to just getting a very one-sided opinion. So The analyst information from our website is from FinHub. It's very up to date, very accurate, and it is expected that it will not match other sites. My advice is to take analyst estimates with a grain of salt. These people are often wrong and don't really know where I'm looking at more than you. That is not always the case. I think some analysts are very good, but unfortunately, there's a lot out there. So I would have that play an influence in your investment strategy to maybe gut check some of your opinions and things like that. But I would be cautious to completely guide an investment decision. Not that you suggested this, Maram, on just analyst data. So I would love to answer any follow-up questions you guys have here on any other data on our website. You can always hit up support@stockunlock.com, and this guy will get you back. So yeah, thank you for that.
Yeah. What I would also say is, just in my own experience, not just on Stock Unlock, but with a lot of other platforms as well, is these smaller cap stocks and the analyst projections on these smaller cap stocks seem to be quite wild. Typically, like what I've noticed is analysts, for the most part, do get it pretty right with like Apple, the big companies, because there's just so many high quality analysts watching those. But when you got like a small obscure stock like TTCF, for example, let's go and take a look at that. Like when you go to our insights, all of our insights that we make based on the fundamental data basically say this company's not that good, right? But then when you go down to the analyst data, they're all super bullish on this stock.
They're also they're trolling us too with the 420.
Yeah. But yeah, you can see like they think EPS is going to grow by 30% next year, revenue 30%, EBITDA 21%. They say the stock is massively undervalued. But like when you take a look at the actual fundamental data that we have, it's like pretty bad. So that's what I mean is I would just be careful, especially on small cap stocks, because it's not just Stock Unlock that says this. It's like every platform that I've ever seen with analyst data on small caps, they're just like shooting for the fences, man, swinging for the fences. And
This isn't baseball. This is investing. What are you talking about?
Sorry.
I see a stock in the chat that I'm pretty excited to talk about because I argued with so many people about this stock at the last job that I worked at before I left. Okay. Thank you, Simon Storm, by the way. I hope your last name's actually Storm. That would be pretty cool. But if not, you're still cool. So there's a couple stocks in here. Daniel, can we pull up Lemonade? So Lemonade is an insurance company, and this stock flew. This stock went up to almost $200 a share. And I was arguing with people at my past job because people started buying this stock and they said, it's a technology company that could be the next Google of insurance. This is great. And that is when I was getting super, super, super passionate about really diving on financials. And I was trying to explain to people that this company was a money burning machine and that they shouldn't be worth, I don't know maybe we could look at their market cap in the freeform tool, but their market cap was huge. So let's say if it was like a $20 billion company, right? I'm like, You can't have a company that's valued at $20 billion that's losing hundreds of millions of dollars and having a revenue like price to sales ratio that was through the roof. I'm like, people just completely got detached from reality. And what sucked is I was in the bubble and they IPO'd before the bubble. So they like were at the front of that crest wave, just riding it up. And I just feel bad because a lot of people I know lost a lot of money on this stock. So yeah, let's see how people could have avoided this, and not to completely dump on them. Like, I think they're actually building some cool stuff. We're just talking about the valuation of the company and how it relates to their financials, which is, as we always say, Daniel, very important to know.
Very important. I'd say it's almost everything. All right. So at the peak here, it was a $9.5 billion company, so almost 10 billion. Now, what I want to see is the price to sales ratio.
Sorry about these bots in the chat, everyone. I'm blocking them as quickly as I can. Obviously, they don't represent us or our views, but bots will be bots. Sorry, Daniel.
Okay, so this company was selling for a price to sales ratio of 100. Now, think about this. What does that mean? Okay, like, yeah, that's
holy crap.
I know, but let's talk about this, okay? Because what does this mean? We could say, oh, it's got a price to sales ratio of 100. That's ridiculous. That's insane. But why? Why is that insane? Right? So here's why. This means that if a company has a price to sales ratio of 100, that means that it's valued at 100 times its revenue. So let's say that the company has a 100% profit margin and all of its revenue can become profits for you. It has no expenses. It's the perfect company. it would still take this business 100 years to pay you your money back if it had a 100% no operating expenses, just a 100% margin, profit margin. That is insane. And obviously companies have operating expenses. So when you're paying a 100 price to sales ratio for a business, it's going to have some operating expenses. Let's say it even has a 50% profit margin, which is still insane. It would take 200 years to get your money back if you bought this business. That's how insane this is. Like,
Yeah,
man, it's just wild.
People are treating it like a tech stock, but I think when you look under the covers, it was more or less just an insurance shop. But yeah, let's see how they're doing now, because if this is true, what we're looking at, it seems the stock is growing revenue even though it hit the floor. So to give Lemonade some credit here, when stocks behave like this, the savvy investor who's patient can start looking around and looking for some deals. So maybe this is a deal now. I haven't looked at it, so let's see if we can figure that out. Insights say no, though.
Yeah, the first thing I want to do, I just went to their financials tab and like started seeing some red flags instantly. So I was like, we need to go look at the insights first. So,
are you trying to tell me, Daniel, that you don't only look at revenue? Because I don't think that you've made that clear yet.
Revenue over everything, dude. Everything.
We're gonna stand up a Stock and Lock swag store soon. Like maybe we can come up with some like cool shirts.
Yeah, for sure.
Just saying.
Anyways, this thing's got a profitability score of 1.33. Operating margin is negative 140%. Oh
okay.
My goodness. Unprofitable, lost $300 million in the past year. Okay, where's the financial health? Because this is what I saw in the financial statement. The shares are increasing by 8.6% over the past year. So this thing is doing decent dilution. And if we take a look at growth, book value is increasing. So they're an insurance company. So their gross premiums earned are increasing, revenues increasing, operating income's going down, net income's going down, and book value is going down. So yeah, the revenue's growing, but basically the actual earnings for the business are declining. And we take a look at the shares on a quarterly basis. Their shares have been growing. Well, they've grown quite a bit in the past quarter. So I actually wonder, was that stock-based compensation or did they dilute?
Yeah, that was my next question too. It's like they're burning money. Then the next question is, where is this money coming from? Which is usually raising debt and or diluting shareholders.
Yeah. So, I mean, what's the valuation today? It's a $1.43 billion company today. What was their, they don't have a net margin. They're losing money. So, I mean, they're still 7 times sales. I don't know. I still think it's kind of expensive, man.
Yeah, I don't like how the share count went up. So if you held a share of this company when it was trading at $100, you have a double whammy of not only are you down 80%, but you actually own less of a percentage of the actual company than you did before because they are putting more shares on the market. This seems incredibly risky to me, and not financial advice, but I'll take the words out of your mouth here, Daniel, and say hard pass from the Stock and Lock crew. Maybe someone in the chat disagrees. You could give us your case here, but we don't like it.
I don't like it.
I don't like it. I don't like it.
It's very.
Thank you for that one, Simon.
Yeah,
pleasure to have you with us.
I'm a very picky investor. It takes a lot for me to be like super interested in a stock, I feel like. Anyways, we got a comment here. Signature Bank, please. You got it. Very high insight score, 4.38. Looks like they've been around since 2008. Let's compare it to the SPY really quick. I'm going to assume this is a bank.
That movement on their stock is wild to me. Like that's a mountain right there.
Yeah, so it went from $80 a share to $360. So it went up almost 4x. Here's a dividend. It's got an earnings yield of 14%. Not bad. Okay. Let's take a look. Like, what is this? Okay. Signature Bank engages in the provision of commercial banking. The company is headquartered in New York.
Hey.
1,800 employees when IPO 2004. Has 2 segments, commercial banking and specialty finance. Commercial banking segment consists of commercial real estate lending, commercial and industrial lending, fund banking, venture banking, and other commercial deposits. Specialty finance segment consists of financing and leasing products, equipment, transportation, commercial marine. Okay, so they do commercial banking basically to like real estate lenders, even venture banking, venture capital looks like. and then they do, just some specific lending out there in New York, it looks like. But my goodness, they apparently killed it over the past few years. Let's take a look at revenue. So yeah, their revenue just like started shooting up. Wow, this thing's actually been growing really nice over the years. That looks like,
it's a nice graph for sure.
the only time the revenue looks like it declined quarter over quarter in the trailing 12 months was back in the Great Recession, and it like wasn't even that bad. It was like a 5% revenue drop. For a bank, that's not bad in the Great Recession. But then right here in the first quarter of 2020, like look at that. They just started accelerating growth so much.
Yeah.
So
I wonder if that's from interest. I mean, I don't know the answer to this question, Daniel, but if they make money off of loans and stuff, if that has any tie to the interest rate, I would imagine that the amount of revenue this bank pulls in will go up with interest rates going up. So that would be interesting. Again, not saying that's the case. I would have to take a deeper look.
Their net income absolutely skyrocketed. It doubled from 2020 to 2022.
And the stock is tanking. Like, I wonder if we look at like the business's price to earnings historically, if it's actually taking a dip right now as the earnings are going up.
Yeah. Okay, when I see a stock tank like this, but the fundamentals are growing, it tells me that the market is basically, well, one thing, either it got overvalued and it's correcting itself, or the market thinks that the fundamentals are like not sustainable. Like the business is going to decline in the future.
Yeah.
I'm not seeing any insider transactions on this. So let's go to the free form here. Let's take a look at the price to earnings ratio.
Yeah, and something we always like to say while going through these, when the financials look good, if anyone in the chat is considering investing in this business, look at who they're loaning money out to, look at who their customers are, and you really need to ask yourself, where will those customers be in 2, 3, 4 years? Are they going to continue to have that coming in? Because again, people who are very great investors look under the hood at this stuff. So maybe it's selling off for good reason. Maybe people think that whatever product they're selling will be going down, or that's not going to happen, and this could be an opportunity to start a position.
The price to earnings ratio,
yeah.
The price to earnings ratio right now is literally at an all-time low. It's never been this low. It's below where it was in the COVID crash in 2020.
Wow.
This thing, okay, if the earnings are sustainable and even if they grow, then this looks super interesting. Analysts, okay, what do analysts say? Analysts think EPS is going to grow 8% next year. What's the compounded annual growth rate? So they think the earnings are going to compound at 7% and revenue is going to compound at 9%. Okay, so analysts seem like they're bullish on the future of this business. So this is actually really interesting. I think this is a very interesting stock.
Can we check out one more thing, Daniel? I just noticed this stock also pays a dividend. Can we check out the dividend tab, see if their dividend's been growing, what their payout ratios are? Because I could imagine them raising their dividend payments. You'd have to go and look at their reports to shareholders to see if that's what management plans to do with this money. But
yeah, they have not. They increased their dividend quite dramatically, it looks like, but it's been steady here, so they haven't actually been increasing it.
Yeah, and you have a great question from the chat here, Daniel, from Supreme Lozy. Sorry if I'm mispronouncing that. How do you determine how long it will take for a company to pay their shareholders back? So you said something with Lemonade that I think sprouted this question of, hey, if they're trading at 100 PS and they had, 100% profit margins, it would take 100 years. So that would be a fun one to walk through.
All right. Yeah. So this is actually a really good question. So first off, it's theoretical because when you invest in a business in the stock market, they don't pay you out 100% of their earnings. But that thinking is basically saying, because when you're investing in a stock, you're investing in a business. So it makes you think as if you're buying a business, not a stock. So let's go over to what's a good stock right now. Google's always a good stock. Let's go to Google. In my opinion, not financial advice. All right. So this thing has a price to free cash flow of 20.26. We're going to just call this 20. So you got to think about this. How do I explain this? Let me just think for a second. All right. So let's say we're going to use some theoretical numbers here. Let's say Google is worth $100. If it has a price to earnings ratio of 20, that would mean, a price to free cash flow of 20, then we could divide this business by a price to free cash flow of 20. That means the stock is generating $5 per year in free cash flow. So for example, we could reverse this. If the company is generating $5 in free cash flow per year, and it's got a 20 price to free cash flow, we can multiply that by 20. There's the price of the business, right? Okay. So
much math.
yes. So then you got to think, okay, think about this. The business is $100. You're buying the business for $100. It makes $5 a year. Now, ask yourself this now. How long would it take you to get your $100 back if you bought the stock for $100 or the business for $100 and it makes $5 per year? You're literally just doing 100 divided by $5 a year in cash flow that they pay you, and you're getting 20. That is the price to free cash flow. So quite literally, the price to free cash flow, this number literally shows you one for one how long it would take the business to pay you back all of your money in free cash flow that it generates today. So, for example,
and I think an important thing to add here, Daniel, to kind of hit this all home is when Daniel says this is what a business could return to you, this is a very theoretical standpoint on, like Daniel said, viewing a stock. So it doesn't literally mean this company will return that money to you. That's not what we mean there. It is looking at their cash flows. And the reason why this becomes relevant is once you stack like 100 companies up against one another, you'll start to see some distribution where some companies could return to you in theory, in 4 years or in 10 years or in 15 or 100. And generally speaking, the lower the timeline, which means the lesser valuation that company has. So this is a way to ask yourself as an investor, how much am I paying for this business? Am I paying for growth? What is the market attributing to this? If I'm looking at a list of technology stocks, why is this one 3 times more expensive on a cash flow basis compared to this stock? So it really gets you to start asking a lot of those really good questions.
Yeah, it, like in my opinion, just starts to get you thinking like you're buying a business instead of buying a stock. Like for example, Microsoft's price to free cash flow right here is 28. So it means that it would take longer for the business to give you all of your money back if it paid you out 100% of its earnings or cash flow. But again, companies don't do that. It's just a way to think about it.
Yep.
And yeah.
Yeah, let's take another one from the chat. So there's a few here that I almost want to queue up, and we are doing our best to get to everyone. I want to say, Reagan, thank you for your consistency. I've seen you mention the stock a few times and have been in the stream before. So Daniel, KMP.UN, the ticker is KMP.UN.TO, is a REIT. So that one could be interesting. I know we have not done a REIT yet this stream. Also, hop into the chat. Yes, Supreme Lazi. We love questions like that. Please keep them coming. Desia, I also see your question on Stock Unlock about Uber, and someone else asked about Snapchat. So we are getting a lot of fun ones today for sure. But of course, one at a time. I wish that we could do more. But Reagan, this is your stock. We got you. We see your comments, and today's your day. And apologies if it took a while to get to you, but we do our best.
All right. Killam Apartment REIT. I'm going to assume that this company owns apartments.
Yeah.
But then the question is where? They're headquartered in Halifax, Nova Scotia, 689 full-time employees. So that's the business. It looks like they're an apartment real estate company in Halifax.
Sorry, where is Halifax? I've never heard of that.
Wow. Just wow.
Wow.
Wow. That's Canada.
I'm a New York boy. I've lived in New York my whole life.
That's on the east. That's on the east coast of Canada. It's like right above you.
Ah, dude. That's the great north. For me, like upstate is like north of New York City. So, all right, Shane. Yes, I'm very bad at geography. What matters for you all is I'm a great software engineer. So I'll keep on writing code for Stock Unlock. I will not be doing any geography anytime soon.
Okay, this company generated $1.46 million in revenue in 2002, and it's generated 321 million today. So it's like 200x its revenue in the past 20 years, which is insane. Let's take a look at the cash flow. Cash flows are also growing. They're not like the most consistent cash flows, but they're growing. Okay, that's nice. Not bad. What else do we want to take a look at?
I'm also curious what their dividend yield on cost is. So whenever people buy REITs, and correct me if I'm wrong here, Daniel, generally these are dividend. That's a weird dip. These are generally people who are dividend focused investors that, they'll look in, see, where's their real estate or property? Are their tenants going to keep on coming back and all that? So the dividend yield on cost is cool because if you buy and hold these shares, if they continue to grow the business and pay a dividend, your yield on costs becomes more and more attractive over time. That's been one of my favorite metrics to look at recently.
Yes, absolutely. But I just went on a little bit of an investigation, so I'm sorry.
Dude, go for it. This is great.
Okay, so here's the thing, right? We were taking a look here at the stock. We have the revenue that grew by 150x, okay? Not percent, 150x over the past 20 years. So I'm sitting here like, okay, that's like ridiculous growth. Like that's just not even real, okay? It's real. Okay, I'm being dramatic. Anyways, then we take a look at the operating cash flow. Then we take a look at the operating cash flow. Okay, $2 million in operating cash flow in 2004, 128 million today. So their operating cash flow has 60x over the past 20 years. Then let's go back to the stock price really quick. The stock price over the past 20 years, it's actually up quite a bit, but it's up 11 times. So if the revenue's grown by 150x, if the operating cash flow is grown by 60x, why hasn't the stock grown by 60x?
What is the revenue per share looking like? Is that where we're going here? Because it looks like they're diluting the living hell out of these shares.
So then I went to the diluted shares outstanding, and there you go.
Dun, 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 dun.
This is why the share price is not growing with the fundamentals, is because they are diluting shares to expand like that. So the share count has 20x'd over the past 20 years. That's how they're growing, which is exactly why, again, the share price is not growing as fast. Don't get me wrong, though. That share growth is insane. That's still like over 1,000% returns, which is better than the SPY. But you got to factor in, they are diluting quite a bit. So if we go to the revenue per share, as you said, Jake, you can actually see that the revenue per share since 2005 is down. So even though the revenue is growing so freaking much, right? Because of all the dilution they're doing, when you do the revenue on a per share basis, it's flat.
This is why I love stocks and I love Stock Unlock, and exactly why we started this business, because there is financial engineering going on out there that is not obvious, but when you pick it apart like this, things become clear. Now, what is also clear is we're not saying yet if this is a good or bad buy. There are use cases where it's actually valid and not a bad strategy for a company to dilute their shares if they are building more value for shareholders than they're getting from selling. So if a company brings in $1 from selling a share, but they create $1.50 from shareholder value, me as a shareholder, I'd say, hey, dilute away. If you're making more money by diluting and it's being great to me, awesome. But what you just showed us is it seems a little flat. So I don't know how I feel about this one. It's
okay.
Yeah.
One thing that's important to say though there is that was a revenue per share. So let's take a look at the operating cash flow per share. And right here, it's growing at a compounded annual growth rate of 6.74%. But again, when you take a look at the operating cash flow growth versus the operating cash flow per share growth, like you can see the operating cash flow is growing at 15% a year, but on a per share basis, it's less than half. So the dilution is taking away shareholder value, but it's still growing shareholder value. But what would be interesting is let's take a look at the stock price over this time. And the stock price grew at 3.35%, even though the operating cash flow grew at 6.74%. That's probably because they pay out a dividend. So the returns also come from the dividend. But yeah, I mean, that's stuff you got to consider, right? Again, we're not saying this is a bad business because clearly it's been doing fine, but you do have to think about the dilution. And even over the past decade, the price to operating cash flow has actually been pretty consistent. The lowest it's gotten has been about 11, 12. 11 right there again. Right here in the recently it was 13. It's about 15 now. Its average is 15.34. So relative to history, it's selling slightly below its historical averages. So it doesn't look like it's super overvalued to me. Yeah. It looks like an all right REIT. Like, let's go take a look at the dividend tab now, Jake. Let's finally go get to that.
Yay. we did it.
Okay. Over the past decade, including dividends, this REIT is underperforming the SPY, though. Over the past 5 years, it's still underperforming the SPY. over the past 20, it's got to be outperforming though. Yeah. Okay. So basically, if you bought this stock right away, you would have massively outperformed the SPY. But if you bought it basically any time after 2004, then you're underperforming the SPY, including your dividends. So I don't know. Over the past, what is that, 18 years? Over the past 18 years, it has underperformed the SPY, mostly because of all the dilution it does. So for me, I'm going to say I don't really like this one. I think there's better REITs out there personally.
Some pros, some cons. Yeah, I agree
The
with you there,
dividends also
Daniel.
dividends also only growing at 3% a year. It's not incredible. So I don't know. Seems okay. Like not amazing though.
Yeah, I'm gonna put a comment up from the chat. So we love taking comments about Stock Unlock. By the way, obviously, I mean we're super passionate about the company that we're building. Hi, Daniel and Jake. Are you planning for any Thanksgiving or Christmas offers on Stock Unlock? Well, first off, very happy future Thanksgiving to you and any holidays you will be celebrating this season. I hope that they're great. We have a few things. We're likely going to be finally dropping our portfolio tracker. We have been beta testing that. Full disclosure, I'm saying this as an engineer, lots of complexity that we didn't see, but also gives us a lot of reassurance that's why there's not a lot of great portfolio trackers out there. So we are putting our best foot forward with that feature and making sure that it is battle tested, ready, and featureful for you all when we launch that. Insight screener. So all the stock insight scores you're seeing, we're going to release a screener soon. So that's a little bit of a present for you all as well. I am not sure, Rax, if you were talking about any sort of a discount. Our mindset on discount is it's something we're considering, but right now leaning towards a no. But the main reason why is we're already pricing Stock Unlock at what we believe is as competitive as we could possibly price it while still obviously having cash flows. I feel comfortable saying, Daniel, that while we grow our startup, we're still not at the point yet where we can bootstrap ourselves with cash flows from subscriptions to keep on growing the business. So for the price of $6.99 per month, that is one half of a minimum wage dollar per month, or it's 75 for the year to get less than that. So very respectfully, I do feel like we are very low there. I will not say we will never do that. And if you have a situation where you would benefit greatly or you have an issue with the price right now, let's have a one-to-one chat, message support@stockunlock.com. We're very friendly. I'll answer, and I'd love to have a deeper conversation about this. And thank you for bringing that up in a constructive way. Appreciate it. Any thoughts there,
Yeah.
Daniel?
My thoughts is this is a very well-timed comment because I think it was just in the last week we talked as a founding team about this. That was in the past week. And yeah, basically the conclusion we came to was just echoing Jake. Like if you go and take a look at every single one of our competitors, especially the value we believe we provide with Stock Unlock, like our value for price is insane. So yeah, right now we're not really considering any discounts.
Will Stock Unlock work with stocks on the London Exchange? Yeah, we got global stock. So if there's a stock that you can't find, let us know. We have over 130,000. It's international. Thanks for that question, G-Man.
Absolutely. Okay. SM Finance. Oh, sorry.
That was me.
SM Finance. Sorry, bud. SM Finance. By the way, thank you for being here. You're a very consistent viewer. You asked about Manulife. I actually think I talked about Manulife in yesterday's live stream. I did. Yeah. So I'll summarize because I've already talked about this one yesterday. I see Manulife as a bond. I agree with you. I think it's like a super value investment. I saw your comment right here says seems like a super value play. I agree. This company pays a very nice dividend. That's why I view it as a bond in my portfolio. I think the dividend's near like 6% right now. And the company is growing, but their growth is like this because they're an insurance company, which is kind of just how things go once in a while. But the company also said, so if you're going to, oh, no problem, SM Finance. But if you're going to be considering Manulife, the company has stated very clearly that their goal is to have 50% of their net income come from Asia. I believe they're in Hong Kong. They're in Vietnam and Indonesia, areas like that in Southeast Asia. I think they're also in China. So if you're someone who is not comfortable with China and investing in Asia, you really got to consider that with Manulife because again, the company has very clearly said they want to grow their 50% of their net income to come from that area of the world. Personally, I'm bullish on that because that area of the world is expanding economically incredibly well. So I'm fine with that. I think they're going to provide some growth. I think their dividend is stable. I'm happy with it. And I don't worry about the stock at all. But yeah, that's just kind of my thoughts that you should consider for yourself as well.
Yeah, and I just noticed that we hit the hour mark here. I think that we might have time for one more. I know I have a lot of fun coding for Stock Unlock, which is going to be super fun. But I do want to take one more. I have such a hard time ending these streams because it is just way too much fun. I love stocks. It's like
I
it's
know,
that
me too.
simple. And for everyone giving suggestions, again, we always do our best to try to get through all of them, which is unfortunately impossible. So if you are not called on this time, please keep joining us. And the more repeats of names we see, I definitely do favor people that I see who come here every week. Just gotta, have some type of seniority going on here. So we do our best. And thank you everyone for being active in the chat.
Yeah, so I'm trying to do one that we haven't talked about on the live stream before.
Uber or Snapchat, I think would be great. I saw both of those above. I think Uber is incredibly interesting because they were one of those companies that had top line up, bottom line down, and you could see that. But they are starting to correct that ship. And I'm not a shareholder in Uber, but I'm starting to look like I think that they have a moat and like a duopoly with Lyft around rideshare personally. I also see them going into other revenue streams and stuff like that and taking opinions from other people that I watch on their podcast. There is a bull case here that the amount of influence and money and pull and people working at this organization that Uber has, they could just turn a dial and start getting cash flows coming in like crazy. Obviously, most of us have used Uber as well. So I think that their financials have turned around a lot. So it might be worth another look.
Yeah, I would agree with you. I mean, I think everyone knows what Uber is. I use Uber all the time. When I was visiting you in New York, I was using Uber all the time. So yeah, we get like their revenue since 2020, end of 2020, the revenue has like actually grown a lot in the trailing 12 months. The revenue has almost tripled since the beginning of 2021. That's actually insane. Okay. But okay, gross profits are growing. I know this company had a ridiculous amount of operating expenses. So let's take a look. So their operating income is still negative, but it is getting close. Not quite there yet.
Yeah. And another thing about this business to keep in mind, killed during COVID. Just so we had a conversation about Airbnb on Stock and Lock Talk number 10. If you want to watch that, it's at the beginning. And one of the things that I liked about that company was they weathered the storm. They got through COVID when their business and revenue got hit. So this is a resilient business. They also had billions of cash, so like that helps.
Yeah, absolutely. I think Uber is one of those companies that like whenever they want to raise money, they just can. It's like so. Yeah, they survived COVID pretty well. But you can see this right in 2020. In the middle of 2020, they were losing like $4 billion in operating cash flow. And you can clearly see that since then, they've been really turning it around. And now they're actually operating cash flow positive. Their CapEx is low, which means that they're actually free cash flow positive now. And they've generated $500 million in free cash flow. But I am also still seeing that they like to issue shares almost every single quarter. They do some sort of dilution.
Yep. And just tying in the storyline here from the person who asked this, Desia, I just put up the comment. They did say that, Uber stock, it shows not good insight and analyst recommendations a strong buy. So tying this back to our insight scores and stuff like that too, I think is a good narrative to string through here.
Yeah, I agree. Okay. Let's take a look at their total tangible assets. So their total tangible assets are declining actually. Is their book value declining? Yeah. So they're taking on liabilities faster than they can grow their assets, which is why the book value is going down. So this company is taking on more debt. I mean, the thing with me is like, I don't know how profitable this business can get. Like, let's go and take a look at their margins.
And if I'm making weird faces, everyone, I'm like typing in the chat. I'm trying to work on my like typing face because I feel like I get super like cockeyed. You know, like that focus face, Daniel, where you're like in flow state and like you in your own head, you're killing it, but it like looks like you just ate like 10 pounds of pudding and you're like just like kind of losing it.
Yeah. Okay, so Uber has an operating cash flow margin of 2.6%. They've never been profitable though, which is why I'm saying like I don't know how much money this business can make. Let's take a look at the gross margin. So the gross margin is 31%, peaked out here at 40%. So like the gross margin, if we go to our insights, that's like an average gross margin, I believe. Yeah, 31% gross margin average, but every other profit margin is negative. They have really high operating expenses. Shares are decreasing, revenue's growing, gross profits increasing, operating income increasing.
Yeah, and something the financials don't show here, Daniel, and I am not an expert in this, by the way, full disclosure. Uber, obviously, their business started as a driving app. They're a network of drivers. I get that they're going into other revenue streams now, but a lot of their profitability and business model hinges on the fact that their drivers are not W-2 full-time employed humans at their company. They are contractors, and that has a big effect on the operations for the business. And we know, being business operators ourselves, Daniel, if we were to hire an employee, the difference between a 1099 contractor and a W-2 is a huge business expense. Like you could be paying, let's say, $100,000 a year for a contractor, $100,000 a year for an employee, but the employee is actually going to cost like 150, 170K a year because you need to buy benefits, insurance, offer them all those things that are really good. Like employees should have those. And there is a lot of legal back and forth, I know, with the classification of these drivers for the Uber app. And that is something to be aware of if you were to invest in this business and kind of understand the effects that will have on their operating cash flows and things like that, depending on where politics go, where they're operating.
Yeah, I definitely agree with that. And I actually remember hearing about that. So I have no idea how much money this company is able to make. I don't even know how to think about that or predict it at all. So let's go into hypothetical land now. The 10-year bond is yielding 3.7%. So Uber's market cap today is $57.6 billion. So for this company to yield investors 3.7% on a $57.6 billion market cap, we have to times that by 0.037, I think, to find 3.7%. Is that correct? Yeah. Okay. That would mean that Uber would have to generate $2 billion in free cash flow to yield what bonds are yielding right now, which would also mean that they would have to, what is that, over 4x their free cash flow. So realistically, let's do a 5% yield just to give us a little bit more. Okay. So 57.6 multiplied by 0.05, $3 billion in free cash flow. Do you think Uber can do $3 billion in free cash flow in a relatively short amount of time?
Just the math of me is I'm gonna assume that like relatively short is 1 to 3 years.
Yeah, I would say within the next 3 years. Okay, 3 billion within the next 3 years. Do you think that's?
I think it's possible, honestly, but I don't think that would make me want to invest in their business. But like we are talking about an international, very large company that has huge market share in the rideshare industry. So I think it's possible. Just to like kind of make my own opinion here clear, I'm not an investor in Uber. I also don't plan on purchasing Uber stock since, with some of the points you brought up before on the driver classification, as well as just, like them still not being super profitable. I just have my eyes elsewhere looking at other stocks. So I don't even have too much bashing to do here. Like, it's just like, there's like not enough meat on the bone for me, but I guess, but I do think it's possible. Would I bet on it? I don't know. Should we take two sides of that bet? Like a fun gamble? Put a calendar appointment 3 years out, over under.
I'm not a gambler. Anyways, this is my thoughts. This quote right here, this comment from Eager Beaver 22, love the name. Uber is a mediocre business. Not a great business. I agree. I think that right now, I don't think it's going to go under. I think it's going to stick around. I think they're going to figure things out, but I see it as speculative. Like the company makes no money. There's I have no idea how to predict how much money it can make in the future. Its margins are slim. Is that going to improve? I don't know. How much? Who knows? So I think that I think it's speculative, and I don't like speculation. So I would not buy it personally until I see more improvement. Like me, who knows, man? Maybe in the future they fix things, things get great, and then I'll take another look. But I'm happy to miss it right now.
Yeah, I mean the rumors are like word on the street is they're trying to create like that super app. Like I always forget what it's called in China, but they, Uber has the ability to tie things together a lot, right? So they got you on the rides. They're also starting to add in other experiences like food, and you can just start using Uber to, really like almost plan the entire trip, right? With the, you need Airbnb though. I'm a shareholder in that, but yeah, I think this is a really interesting one. I could definitely see there being a lot of bull case arguments here, but plus one to what you said, just there's tons of thousands of stocks out there, and like, is this one of the best? It's not extremely clear, but you know what? Maybe that's opportunity for someone else out there. So
I just think, at a basically $60 billion market cap already, it's like I think a lot of good future for that business is already priced in. So it's like, okay, if Uber was a $5 billion stock today, then I could get behind it and be like, you know what, maybe that's worth the risk. But at a $60 billion valuation, it's like even if things improve, you're already paying for that. So
fair. Yeah, that's a really good point too. I don't even have anything to add. Like, just great way to look at it. Valuations matter.
a lot.
Surprise. Yeah. All right. How are you feeling, Daniel?
I mean, I feel all right. How you doing?
I'm doing good. I know we said that was the last one, but
Have you taken a look at Alibaba's earnings at all?
I haven't had a chance. That's what kills me. It's so funny because I spend all my time coding Stock Unlock, and Stock Unlock is helping everyone analyze companies' financials and get into investing. And like, I need this too. And it's almost just funny that I'm spending so much time coding it that, when I get off the computer and my eyes are cracked because it's 2:30 in the morning and I've been coding for 12 hours, I don't really have the energy to start going through an earnings report. So I do actually have on my reading list for this weekend to actually just really go through the company's earnings presentation. I really want to stay aligned with what their plans are for future revenue streams. Like, they were a little bit all over the place, marketplace, cloud, some like media type business. So I'd like to see them gain more focus and really track their cloud growth. And yeah, just haven't had time. I'm a passive investor though, so I'm not looking to buy or sell on earnings reports. So for me, I don't feel a huge rush in doing it, but definitely a little bit behind on my own. This was the most looking at stocks I've done all week, which is part of the reason why I'm having so much fun.
Yeah, I haven't taken a look at Alibaba either, and I own shares in the company, a small position, but I'm like you. I don't even think if they had a bad earnings report, I would sell it, because I just think that in 50 years it's going to be much bigger than it is today, and that's why I hold it. So like, okay, if they have a down quarter, ooh, cool, sweet. Does that change where they're going to be in 30 years? Probably not. So yeah, I'm kind of sad to say I haven't looked at the earnings report either. I was kind of hoping you would, so you could tell me what's going on. But I guess that's
I got you next. I'll get you next week on that for sure.
Cool. Okay. Because we have a question here. And any update on Alibaba's earnings? And like, I just can't. So
yeah. Next time, Ajay. What is your market sentiment at the moment? So I think for our channel and the content we put out, we do our best not to make predictions on the market. I mean, the obvious sentiment, not from us, is it's red. Like, we are debatably in a recession. The broader mindset here, and probably to take words out of your mouth, Daniel, is when stocks go down, deals start to come up. I have not been buying too many stocks, mostly for the past year, because the market just ran, everything was hot. But I started buying stocks again a month or two ago. So I have no idea where the market's going. Daniel has no idea where the market's going, and we do our best on this channel to not make predictions around that, because anyone who tries to predict where the market is going honestly has no idea. I'm not trying to bash those people, but no one can predict the future. If they could, they probably would, be somewhere else, not telling you where they think the market's going.
Yeah.
And yeah, what do you think, Daniel?
Yeah, sorry to cut you off, but I think the newsletter that we wrote today kind of addresses this a little bit. So Stock Unlock is based on Warren Buffett, Charlie Munger, Peter Lynch, all of these legendary investors, their investment principles, and like things that actually work over the long term to build wealth. That is what we're focused on because we want to help all of you guys build your wealth with us because we use Stock Unlock too. And basically, in the first area, after I talked about what Warren Buffett is doing in the market right now, he is a buyer and he is buying big. While you got people on CNBC, oh, we're in a recession. Oh my goodness, what is the Fed going to do with interest rates next week? Oh my, ugh. All anyone can ever even freaking talk about. And then you got Warren Buffett out there who's like, I'm buying so much stock right now, it is just stupid. I'm spending tens of billions of dollars every quarter buying stock. And it's like,
dude, your
focus.
CNBC imitation was 10 out of 10. We'll leave it at that.
Thank you. No, but seriously, it's like Warren Buffett focuses on businesses. He doesn't focus on what the stock price of that business is going to do. Just look at the business. If it's a good business and it's selling at a fair price, I buy it. Warren Buffett buys it. Peter Lynch buys it. Charlie Munger buys it. That's what the best people do. Best investors do, sorry. So yeah, at Stock Unlock, we try to focus on finding good businesses. And we don't try and focus on like, okay, what's the market going to do next week, next month? We have no idea.
Awesome. Yeah, great question too, by the way.
Yeah, seriously.
Yeah, and Daniel, I did just look at the time. I do think I need to be responsible and write some code for Stock Unlock. So you have an open door. I know sometimes you like hanging out a little bit longer. So how are you feeling? Are we parting ways here, Endon, or are you going to keep going? I almost feel guilty, but I got to pull the plug for myself here at hour 16 minutes in.
Yeah, I should probably go too. It's getting late. Shelby's going to be back soon, and I got to get dinner ready.
Hey, well, we love talking with you all every single week. Again, normally we go live at 11:30 a.m. EST on Saturdays. It is, of course, Friday, and this is a one-off for us. Definitely hit that bell icon on our YouTube page to get notified when we go live. We have a free Discord that anyone could join. If you're not on stockunlock.com already, what are you doing? Support us, support yourself, check it out. Completely free to get 14-day free trial. We don't take your credit card or anything like that. And again, thank you so much all for being here. It's always a blast. I need to contain my excitement from jumping so much, honestly, because we have so much fun.
Yep, I agree. Just thank you, everyone. As we always say, thank you for tuning in. I think next week we'll most likely do Saturday. As of right now, Stock Talk will be next Saturday. We'll let you know ahead of time again if that changes, though.
Yeah.
But yeah. Should be Saturday next week, eh?
Great.
Yeah. All right. So yeah, thank you everyone so much for tuning in. We really appreciate it. And yeah, we'll see you next week.
Bye, everybody. Taylor, are you going to say goodbye also? Bye.
Oh, hello.
Yeah. Special guest.